It's time for the MF Corner on the show. Today, let's evaluate how large and mid-cap funds have withstood the volatility in the month of May. Joining us, as always, is our mutual fund expert, Dhirendra Kumar, CEO at Value Research. Afternoon, Dhirendra. Multi-cap funds have, as a category, done much better than the Sensex in the month of May. Topping the list was Fidelity India Special Situations Fund. What has made this fund deliver?
This fund, tries to be in out-of-favor stock, so to say, and looks like the whole market is out of favor. But it has been. That's not the rationale. The rationale why it has done little, better than most other funds in this category, best in this category, is its 40% allocation to financials. Most other diverse funds don't do that. The other is 10% allocation, 10%, nearly 10%, 9.5 or so, to National Stock Exchange, an unlisted position, which has which normally is valued on a fair value assumption, and we don't have active trading reference, trading price reference, so it's on a fair value basis. That's why we haven't seen the decline here.
Dhirendra, DSP BlackRock Focus is the biggest laggard for the period. What has dragged its performance according to you?
This is a reasonable fund, not a very old fund, just about a little over a year old. But I think any fund in this category which tries to which is trying to concentrate, we have seen that extreme volatility comes to a fund when visible in a fund which tries to concentrate. Yesterday we were talking about that Religare Agile, which is once again in 11 stocks. Similar here. When you have large position, outsized position in specific stock, and something goes, something is not out of favor, normally these kind of funds tend to be at the top or at the bottom. And I think overall on a longer period, it does not translate into any meaningful benefit for the investor.
Dhirendra, let's also take in some viewer queries. Our first query is from Ankur Bansal. He wants to find out the difference between the following debt funds: short-term fund, ultra short-term fund, income fund, liquid fund and gilt fund.
There are different ways of classifying it, but this classification, of which the legal classification is only of two kinds. One is the liquid fund and non-liquid fund, which means all other kind of debt fund. From taxation point of view, this is the way to classify. Liquid funds, they don't invest in securities of more than 91-day maturity. Very soon, from September, it will be mandatory for them to be investing not in securities not with a maturity of more than 60 days. So they will become, the underlying portfolio will be liquid, so to say, and the tax treatment is also marginally different. Other funds, these are this is Value Research classification, and which is well accepted. That is what is followed in the marketplace as well, which is the ultra short-term fund with maturity ranging between 90 days and up to 1.5 years. So they are very, very less volatile, and one is able to derive the yield on the portfolio amply reflected in the fund performance. The next comes short-term bond fund with maturity ranging between 1 to 3 years, not exceeding 3 years. So they are also very less volatile. One is able to, last year short-term bond funds were was the best performing debt fund category, and it was able to deliver 9% with great high consistency. Income fund, which is the most flexible one, here the fund managers actually take a view on interest rate, and that shows in their portfolio. So on occasion, the portfolio maturity can well be up to 15 years. On occasion, it could be very low. It could be 1 or 2 years, or maybe less. And here is a fund which is a key beneficiary of rate cuts, and that is a time when we see massive inflows. And the last category, the gilt fund, which is a variant of the income fund, except that the underlying security must be government securities only.
Right. Dhirendra, second query today is from Mohit Vij, and he says that he's a first-time investor, can invest about 5 to 10,000 per month in SIPs. Can you suggest what funds he should go in for? And he says that he needs at least 15 to 20% return on a yearly basis for a time period of 5 years.
Very difficult to recommend something to someone who is expecting some kind of guaranteed return. But that apart, If he has to take a market exposure, I think the best way, it could be a very difficult time for somebody to get started, but he should stay the course if he chooses to. He should choose, he should invest in 1 or 2 balanced funds and continue investing for next 5 years. And despite a very difficult market which one might be faced in the interim, if I have to recommend few funds, he can choose any 2 of these, 3, 4. Birla Sun Life 95, DSP BlackRock Balanced Fund, or a Canara Robeco Balanced Fund, or Tata Balanced.